What is up, everybody? This is Stock Market Education, and today we're going to be talking about the stock market and whether or not we have already seen the bottom. Let's get into it. We have witnessed a historical global recession for the majority of 2020 with record unemployment rates, plummeting demand for gasoline, and the stock market crashing faster than the Great Depression of 1929. When will the bear market be over? Are the market lows already behind us? Will it recover in a V shape, U shape, or worst case scenario L shape? These are all million-dollar questions that investors are trying to find the answer to. But before we get into the video, make sure to click the like button, and if you're new to the channel, go ahead and click the subscribe button. My videos are designed to be short but packed with information so that your time and my time isn't wasted. With that being said, let's go ahead and take a look at some charts. When we take a look at the VIX, or what is commonly known as the instrument that measures fear and volatility in the markets, has been dwindling since the middle of March and has continued to go down, which suggests that the worst part of the crash is behind us. And if we look at the price change in stocks over the past 2 weeks, we can see that volatility continues to be stretched. However, there has been more positive days compared to negative days in the market over the past few trading days. And in addition, volume of this crash has mirrored the volume activity of the infamous 1987 crash. We might see volume decrease substantially over the next few weeks, however, only time will tell. Looking at earnings per share estimates for Q2 2020, we can see that the markets are expected to shave off 15%, and it seems that the markets will be looking towards guidance for confirmation. So if guidance falls short, it will undermine consensus, and if guidance beats, it will spur optimism. Unfortunately, it is safe to say that Q1 and Q2 reporting cycles are going to be hit hard. Volume levels of this crash have mirrored the volume activity of the infamous 1987 crash. We might see volume decrease substantially over the next few weeks as well. In addition, the Fed has lowered interest rates to zero amidst this crisis and has implemented lending services to help promote liquidity and financial conditions for the short-term markets. And the government took advantage of these zero interest rates to provide a generous $2.2 trillion stimulus package to relieve American families. However, this stimulus has come at a high price, adding $3 trillion to the deficit, which can add to inflation in the medium term. And in other news, Bernie Sanders announced that he has officially dropped out of the presidential election, which sent stocks higher and has cleared the path for Joe Biden as the Democratic nominee, which relieved fears of possibility for high income taxes across the board, and healthcare conglomerates like United Healthcare saw a spike in activity today. Taking a look at the stochastics indicator for the SPDR, we can see that the SPDR has crossed over the overbought levels, indicating that this might not be a good time to buy. And when you take that into account with the reality that prices have gone up 20% in only a matter of 2 weeks, it is fair to be skeptical that the markets are not going to keep rising to their recent all-time highs in February, or otherwise known as a V shape. However, from a long-term outlook, stocks are still below their 25-year averages in terms of valuation, which would suggest a buying opportunity for long-term investors. Are you guys buying more stocks right now or not? Do you think the worst is behind us? Will we see a fundamental change in capitalism as we know it as far as employee protection and putting them first? Leave your answers down in the comment section below. Thank you guys for watching this video. Like and subscribe if you've enjoyed this video, and have a great day. Bye.